The Fed's cuts could have some bullish implications for real estate investment trusts. UBS finding REITs beat the market by more than 3% on average in the 3 months following a rate cut. In fact, REITs outperformed the market for 7 years in a row until getting hit in '07. But REITs could end up giving your portfolio that CNBC edge this year. David Brain is the CEO of Entertainment Properties Trust, which owns malls, movie theaters, and ski resorts across the U.S. And Tim Peers, Managing Director, Portfolio Manager at Heitman. Not only a guest, he's also an investor in David's REIT. Gentlemen, good to have you both. Let me start with you, David, and ask what kind of impact the Fed's move, not just yesterday, but last week as well, is going to have on your business.
Well, it's very positive. It's making things flow again. I think the situation was locked up until people would see how the Fed would attend to the situation, and they have. And it's very strong in their presence and what they're doing. And so I think the market is moving again, and people have the idea that liquidity is going to be available and transactions then are afoot.
Whether we're talking movie theaters or water parks or ski resorts, I mean, where is the sweet spot right now? And to what degree are you affected by anything involving weakness in residential?
Well, the company's really structured to be almost recession-proof. Even the ski we're in is not really resort skiing. It's what we call municipal daily attendance skiing. It's the smaller ski resorts that are attended daily and not really bed-based development, but they're outside of major cities in the northern tier of the United States, of course. But recession really is because we deal in those activities that are a little more accessible, both in price and proximity. The company isn't really affected heavily by any kind of recessionary move. In fact, our attendance, particularly the movies, moves up a little as the economy slides away. So it's been it's been good for us in terms of the fundamentals at our properties.
Tim, how do you rank this versus people who are thinking about mall REITs or apartment REITs? Where does this fit in the spectrum?
Well, I think when you look at Entertainment Property Trust, the one thing you have to keep in mind is the properties that they own are structured under very long-term leases. So if you're a little bit worried about the economy, the lease structure is 10, 15 years. So we're not really worried about the cash flows that David's company will be achieving. From a mall perspective, again, when you look at that, we're still positive on the malls also. Yes, a little bit more cyclical, but again, very long leases. And when you look at the regional mall industry, those malls, the strongest regional malls, that's where the retailers want to be. Even in a slowdown, they want to be in the best malls. So I think both when you look at what Entertainment Property Trust is doing and the regional mall industry with long-term leases, that should help cushion you during any kind of slowdown.
Well, but this is Jack Rifkin. Let's talk about REITs in general. We've got some REITs now that are selling below at least stated net asset value. Don't we need some sales here to kind of verify that we've got an NAV that makes some sense?
That's definitely a fair comment. One thing I would keep in mind, as you said, they are selling at a discount, almost a 25% discount, one of the largest discounts we've seen in 10 years. Now, there are some questions about the kind of the validity of that discount in terms of pricing is moving around a little bit in the private market. One thing that David mentioned earlier is that with the credit markets, still tight, it's difficult to get financing for some of the large transactions you've seen in the REIT market over the last 2 years. Again, if you go back over the last 2 years, there were 24 transactions, $85 billion worth of privatizations. Access to low-cost debt made those transactions possible. Now, without that liquidity in the market today, I think pulling off a big privatization is going to be much more difficult today. But that discount is big.
David, you got a comment on that?
Well, I think the transactions are happening, as I said. Liquidity is available, and cap rates are firming some. And I think the NAV discounts are actually pretty real. Cap rates are firming some, but they're not moving precipitously. So I think the NAVs that have been out there posted for a lot of companies in some of the analyst reports that are pretty real. And real estate's really still worth what it's worth, and stock prices have come down, so there are real discounts out there.
So David, are you a buyer? Are you only a buyer? Would you be selling property? What are you doing?
We're selectively looking at selling. Historically, the company has not been much of a seller, and so, but at the same time, we're always there, particularly in a tight credit market. But we're definitely a buyer. We've come into this period. We went out and did an offering just as we came into the fall of '07, and so the balance sheet is in great shape. Our line is paid down. We have a good position of liquidity. We've talked about doing a couple $100 million worth of acquisitions minimally this year, and we're very much a buyer because there are some good purchases out there right now because of the tight credit market.
Interesting. Well, people are looking for opportunities in a market like this one. Good to have you guys on the program.
Well, thank you.
Thanks for that, David and Tim.